There comes a moment in every generation when the comfortable assumptions we've lived by begin to crack, when the numbers we've learned to ignore suddenly demand our attention, and when the future we took for granted reveals itself to be built on something far more fragile than we imagined. I've spent more than 50 years watching markets, studying human behavior, and observing how societies convince themselves that the rules of arithmetic don't apply to them. And I can tell you this with absolute certainty. We are living through one of those moments right now. The United States of America, the wealthiest nation in human history, the country that defined modern capitalism and built the global financial system, now carries a debt burden so large that it defies easy comprehension. We're talking about $36 trillion, and that number is growing by roughly $1 trillion every 100 days. Let that sink in for a moment. $1 trillion every 100 days. That's not a political talking point or an abstract statistic. That's the lived reality of our fiscal situation, and it's accelerating. Now, I want to be clear about something from the start. I'm not here to alarm you or to paint some apocalyptic picture of inevitable collapse. I've lived through enough market cycles, enough crises, and enough moments of panic to know that fear is rarely a useful guide to understanding. What I want to do instead is help you see this situation clearly, to understand how we arrived at this point, and to grasp what it means for your future, your children's future, and the country we'll leave behind. Because the truth is, this debt didn't materialize overnight. It wasn't the work of any single administration or any particular political party. It's the result of decades of small, comfortable decisions, each one feeling harmless in isolation, each one justified by the prosperity of the moment, each one pushing the real cost a little further into the future. And now that future has arrived. Let me give you a sense of scale. $36 trillion is so large that it almost becomes meaningless. Your mind can't really grasp it. But here's what makes it real. The interest payments on that debt have become one of the largest line items in the entire federal budget. We're now spending more on interest than we spend on national defense, more than we spend on most domestic programs, and the trajectory is only pointing in one direction. In the current year, those interest payments are approaching $1.2 trillion annually. Think about that. We're borrowing money to pay interest on money we've already borrowed. That's not investing in infrastructure or education or innovation. That's not building a better future. That's simply servicing the debt we accumulated yesterday, last year, last decade. And as interest rates have risen from the artificially low levels we enjoyed for so long, that burden has grown heavier with remarkable speed. I remember a conversation I had many years ago with a friend who ran a small business. He'd built something successful, something that employed people and served his community well. But over time, he'd gotten comfortable with leverage. A line of credit here, a business loan there, always with the belief that next year would be even better than this year, that growth would outpace the cost of borrowing. And for a while it worked. The business grew, the debt seemed manageable, and the confidence built upon itself. But then conditions changed. Interest rates rose. A key customer left. A competitor emerged. And suddenly those comfortable debts became chains. He spent his days not building his business but servicing his obligations, not investing in the future but paying for the past. He told me something I've never forgotten. He said, I thought I was borrowing against tomorrow's success, but what I was really doing was mortgaging tomorrow itself. That's what nations do too. We convince ourselves that debt is an investment, that growth will always outrun our obligations, that the future will be prosperous enough to handle whatever bills we leave behind. And sometimes that's true. Sometimes debt finances genuine productive capacity, infrastructure that pays dividends for generations, investments that multiply their value many times over. But other times, and I think if we're honest we know this to be true now, debt simply finances consumption. It pays for spending we want today without the discipline of paying for it today. It's the governmental equivalent of putting your groceries on a credit card, month after month, year after year, telling yourself you'll pay it off when things get better, when that raise comes through, when circumstances improve. Except circumstances don't always improve. Sometimes they worsen. And compound interest, that force Einstein supposedly called the most powerful in the universe, keeps working whether times are good or bad. The story of how we got here isn't complicated, though it spans decades. In many ways, it's the story of prosperity breeding complacency, of success breeding overconfidence. After the Second World War, America emerged as the unquestioned economic superpower. We had roughly half the world's manufacturing capacity, the dominant currency, the most advanced technology, and an economy that seemed to grow without limit. We'd defeated fascism, we'd built the atomic bomb, we'd created the modern corporation, and we believed that we'd unlocked some secret to perpetual growth. And for a long time we were right. The post-war decades were extraordinary. Living standards rose. The middle class expanded. Innovation flourished. It felt like we'd found a way to bend the old rules, to create prosperity without constraint. But something else happened during those years. We began to believe that debt didn't matter, that deficits were just accounting abstractions, that a country that prints the world's reserve currency could borrow without consequence. The reasoning seemed sound. We'd financed the war with debt and emerged stronger. We'd built the interstate highway system with borrowed money and reaped enormous returns. Why not keep going? Why not spend on education, on defense, on social programs, on everything that seemed like a good idea? The bills would come due eventually, but eventually felt very far away. And besides, growth would handle it. Growth always handled it. I've watched this psychology play out in markets and in individual lives countless times. There's a pattern to it that's almost predictable. It starts with success. You make a good investment, your business grows, your income rises, and you feel smart. You feel like you understand something others don't, so you get more aggressive. You take on more leverage. You convince yourself that the rules that apply to others don't apply to you because you're different, you're special, you figured something out. And for a while, the feedback loop reinforces itself. Borrowed money generates returns. Those returns justify more borrowing, and the cycle accelerates. You start to think of leverage not as risk but as a tool, not as a burden but as an opportunity. And then something changes. It might be interest rates. It might be a recession. It might be a competitor or a technological shift or just bad luck. But the cycle reverses, and suddenly all that leverage that amplified your gains starts amplifying your losses. What felt like rocket fuel on the way up becomes an anchor on the way down. Nations aren't that different from people in this regard. They respond to incentives, they follow psychological patterns, They convince themselves of convenient narratives. And over the past several decades, we've convinced ourselves of a very convenient narrative, that debt doesn't constrain a country like the United States, that our unique position in the global economy exempts us from the normal rules, that we can borrow essentially without limit because the world needs dollars and treasury bonds are the safest asset on earth. And there's some truth to that. We do have unique advantages. The dollar's reserve currency status is real. The depth and liquidity of treasury markets is real, but advantages aren't exemptions. Physics still applies, mathematics still applies, and the fundamental arithmetic of compound interest applies to everyone, even reserve currency issuers. Let me walk you through what compound interest means in this context, because I think a lot of people hear these numbers without really understanding their implications. Compound interest is simple in concept but devastating in practice when you're on the wrong side of it. If you owe money and you don't pay it back, you start owing interest on that money. And if you don't pay the interest, you start owing interest on the interest. The debt grows exponentially, not linearly. A 10% annual interest rate means your debt doesn't just grow by 10% of the original amount each year. It grows by 10% of the new, larger amount. So year 1, you owe 110. Year 2, you owe 121. Year 3, 133.1. After 10 years, you owe 259. After 20 years, 673. After 30 years, 1,745. The original 100 has become more than 17 times larger, and you haven't spent a single additional dollar. You've simply failed to pay what you owed. Now apply that logic to trillions of dollars. Apply it to a debt that's growing not just from accumulated interest but from continued deficit spending, from the gap between what we take in and what we spend out. We're adding to the principal every single year, sometimes by enormous amounts, and the interest compounds on top of that. This is why the trajectory matters so much. It's not just about the number today, it's about where the number will be tomorrow, next year, next decade. And right now, with deficits running well over $1 trillion annually and interest rates higher than they've been in years, we're in a situation where the math gets ugly very quickly. Every percentage point increase in interest rates adds hundreds of billions to our annual interest costs. Every year of deficit spending adds more principal on which that interest compounds. We're in what engineers would call a positive feedback loop, except there's nothing positive about it. I want to share something with you that Warren Buffett once said, because I think it captures this dynamic perfectly. He pointed out that America is an extraordinarily wealthy country, that we have abundant resources, talented people, and incredible productive capacity. But he also warned that if we continue to pile up debt at current rates, if we continue to make promises we can't keep and to spend money we don't have, we'll eventually face a reckoning. Not because we run out of money in some immediate sense, but because the burden of servicing that debt will consume more and more of our resources, leaving less and less for everything else that matters. He used the metaphor of a farmer eating his seed corn. You can do it. It'll satisfy your hunger today, but next year you won't have a crop. The year after that you'll be even worse off. Eventually, you'll have nothing left to plant. That's what deficit spending without discipline does. It consumes the future to feed the present, and the insidious thing is that it works for a long time. You can eat seed corn for years before the consequences catch up with you. The harvest from previous plantings keeps coming in. Your fields stay green. Everything looks fine. But underneath, you're depleting your capital, destroying your productive base, and ensuring that the future will be harder than the present. And by the time you realize what you've done, it's very difficult to reverse. You can't just decide one day to stop eating and replant the seed corn you've already consumed. It's gone. You have to find new capital somewhere, and that means sacrifice, discipline, and time, none of which are easy when you're already in a hole. History offers us plenty of examples of what happens when societies lose control of their finances, when debt spirals beyond the capacity to service it, when the arithmetic overwhelms the political will to address it. I'm not talking about ancient history or exotic foreign countries. I'm talking about great powers, sophisticated economies, nations that believe themselves exempt from the normal rules. Consider Rome at the height of its power. The empire controlled the known world, commanded vast armies, built monuments that still stand today. But over time, the costs of maintaining that empire exceeded the revenues it generated. Military expenses grew. The bureaucracy expanded. Promises to citizens multiplied. And rather than raise taxes or cut spending, Roman emperors did something simpler. They debased the currency. They reduced the silver content of their coins slowly at first, then more rapidly. This allowed them to mint more coins with the same amount of metal to pay their bills with money that was worth less and less. It worked for a while. The coins still looked like coins. People still accepted them. But eventually, trust eroded. Merchants raised prices. Savings evaporated. The economy destabilized. And that instability, that loss of confidence in the basic medium of exchange, contributed to the eventual collapse of the Western Empire. Or look at Spain in the 16th and 17th centuries. Spain controlled more wealth than any nation in history, with gold and silver pouring in from the New World, a global empire on which the sun never set, and a military that dominated Europe. But the Spanish crown spent even more than it took in, financing wars, maintaining far-flung territories, supporting a lavish court. The result was a series of bankruptcies, actual sovereign defaults where Spain simply stopped paying its creditors. This didn't end the empire immediately. Spain remained powerful for generations, but it marked the beginning of a long decline, a gradual erosion of trust, capital, and influence. The gold and silver kept flowing in, but it flowed right back out again to service debts and cover deficits. Spain became wealthy and broke at the same time, rich in assets but poor in fiscal health. Britain offers a more recent and perhaps more relevant example. After the Second World War, Britain had prevailed over Nazi Germany, remained a nuclear power, still controlled a global empire, and spoke the world's common language. But the war had been financed largely through debt, and that debt burden proved unsustainable. Britain faced a choice: maintain its global commitments and its standard of living, or confront the fiscal reality and adjust. For decades, it tried to do both. The result was a long, painful decline. The empire was dismantled not through conquest but through financial exhaustion. The pound sterling lost its reserve currency status. Living standards stagnated. Industries declined. It took a generation for Britain to adjust to its new reality, to build an economy suited to its actual resources rather than its historical pretensions. The lesson wasn't that Britain had failed. It was that even great powers face arithmetic, and arithmetic doesn't care about history or pride or what you used to be. Japan provides perhaps the most instructive parallel for our current situation. In the 1980s, Japan looked unstoppable. Its economy had grown at remarkable rates for decades. Its companies dominated global industries. Its banks were the largest in the world. Real estate and stock prices soared to levels that seemed to defy gravity. And the Japanese government, believing the boom would continue forever, allowed debt to accumulate, both private and public, at unprecedented rates. When the bubble finally burst in the early 1990s, Japan entered what became known as the lost decades. Growth stagnated. Deflation set in. The government tried to stimulate the economy through massive deficit spending and zero interest rates, and the result was a debt-to-GDP ratio that eventually exceeded 200%, the highest among developed nations. Japan didn't collapse. It remained wealthy, stable, and technologically advanced, but it never regained its dynamism. A generation of young people grew up in an economy where growth was a memory, where opportunities were constrained, where the future felt smaller than the past. I share these examples not to suggest that America will follow the exact same path, but to illustrate a fundamental truth. No nation is exempt from the laws of finance and mathematics. You can postpone consequences. You can paper over problems. You can use accounting tricks and monetary policy to buy time. But you cannot escape the underlying reality that debt must eventually be serviced, that promises must eventually be kept or broken, that living beyond your means has a cost that someone, somewhere, will have to pay. The question is never whether that reckoning comes. The question is only when and in what form. Now, I want to talk about something that doesn't get discussed enough in these conversations, and that's the moral dimension of all this. Because debt isn't just an economic issue, it's a moral one. When a generation borrows money and spends it on itself, it's making a choice about who will bear the burden of that spending. If the money finances productive investments, infrastructure that will serve future generations, education that will make them more capable, research that will make them more prosperous, then perhaps the debt is justified. The future will benefit and can fairly be asked to help pay for those benefits. But when the money finances current consumption, when it pays for programs and promises that primarily benefit today's citizens, when it covers deficits driven by political convenience rather than national necessity, then what we're really doing is asking our children and grandchildren to pay for our lifestyle. We're transferring wealth backward through time, taking from those who have no voice and no vote, mortgaging their future to fund our present. I think about this a lot, probably more than most people do. I think about what kind of country we're leaving behind, what kind of economy, what kind of fiscal situation. I think about young people starting their careers today, and I wonder what opportunities they'll have, what burdens they'll carry, what choices they'll face. And I'll be honest with you, it troubles me. Not because I think collapse is imminent or catastrophe is inevitable, but because I know how much harder we're making their lives through our choices today. Every $1 trillion we add to the debt is money they'll have to service. Every unfunded promise we make is a claim on their future earnings. Every year we delay serious fiscal reform is a year that compounds the problem and narrows their options. There's a concept in investing that I've always believed in deeply, and that's the importance of stewardship. When you manage money, whether it's your own or someone else's, you have a responsibility to preserve and grow that capital, to leave it in better shape than you found it, to think not just about this quarter or this year, but about the long term. The best investors I've known all shared this quality. They thought in decades, not months. They understood that their actions today would have consequences tomorrow, and they took that responsibility seriously. They knew that capital is precious, that trust once lost is hard to regain, and that short-term thinking inevitably leads to long-term pain. Nations need stewardship too. They need leaders who think beyond the next election, citizens who think beyond their own immediate interests, a culture that values sustainability over expediency. And I worry that we've lost some of that. I worry that we've become so focused on what we want now, so convinced that growth will solve everything, so certain that the future will be richer and can therefore afford to carry our burdens, that we've stopped asking whether we're being good stewards. We've stopped asking whether the path we're on is sustainable, whether the promises we're making are keepable, whether the debt we're accumulating is justifiable. Let me be clear about something, because I think there's often confusion on this point. I'm not arguing for austerity in some punitive sense. I'm not saying we should slash spending indiscriminately or refuse to invest in our future. What I'm arguing for is honesty, discipline, and a realistic assessment of what we can actually afford. If we want to spend more on education, on infrastructure, on research, on defense, on social programs, then we should be willing to pay for those things through taxes, through prioritization, through choices about what matters most. What we shouldn't do is simply borrow to pay for everything we want, assuming that growth will bail us out, that tomorrow will take care of today's bills, that we can have it all without trade-offs. The mathematics of our situation are not complicated. We're spending significantly more than we take in, year after year, with no end in sight. The accumulated debt is already larger than our entire economy, and it's growing faster than that economy. Interest rates, while still historically moderate, are higher than they were for much of the past decade, and every increase adds enormously to our interest burden. Demographics are working against us, with an aging population that will require more spending on health care and retirement benefits, just as the workforce supporting those benefits grows more slowly. These aren't political problems that can be solved through better messaging or different leadership. These are arithmetic problems that require arithmetic solutions. You either spend less, take in more, or accept the consequences of the gap between the two. The problem, of course, is that every dollar of spending benefits someone, and every dollar of taxes costs someone, and politics is the process by which those competing interests fight it out. It's much easier to expand a program than to cut one, much easier to promise a benefit than to rescind one, much easier to defer a payment than to make one. This is true of every democracy, every republic, every system where leaders depend on popular support. The incentives all point toward spending more and taxing less, toward pleasing constituencies today and worrying about tomorrow later. And that's why fiscal discipline is so rare, and why debt tends to accumulate over time. It's not that leaders are stupid or evil. It's that they face incentives that make the easy choice and the right choice point in opposite directions. I've seen this dynamic play out in companies as well. I've watched management teams that knew they should restructure, that understood their business model was unsustainable, that recognized the need for painful changes. But they also knew that making those changes would hurt the stock price, anger shareholders, risk their jobs. So they delayed. They managed for the quarter, not the decade. They hit their numbers by cutting investment in research and development, by deferring maintenance, by using accounting tricks to smooth over problems. And for a while it worked. The stock stayed up. The analysts stayed happy. The bonuses kept coming. But underneath, the company was deteriorating. The problems weren't solving themselves. They were compounding. And eventually, when the situation became undeniable, the fixes required were much more drastic and painful than they would have been if addressed earlier. That's where we are as a nation right now. We're deferring hard choices, managing for the next election cycle rather than the next generation, telling ourselves that we'll deal with the debt problem later, when times are better, when circumstances allow. But circumstances never allow. There's always another crisis, another priority, another reason to delay. And every year we wait, the problem grows larger, the solutions grow harder, and the consequences grow more severe. I want to talk about what those consequences might look like, because I think it's important to be specific. When people hear about debt crises, they often imagine dramatic collapses, bank runs, hyperinflation, economic chaos. And those things can happen, particularly in countries with weak institutions or currencies that aren't widely held. But for a country like the United States, the consequences are more likely to be gradual and insidious. We won't wake up one day to find the dollar worthless or the government unable to function. What we'll experience instead is a slow erosion of living standards, a quiet deterioration of public services, a gradual transfer of resources from productive uses to debt service. Imagine that every year, an increasing share of the federal budget goes to paying interest on the debt. That money doesn't build roads, doesn't fund research, doesn't educate children, doesn't defend the nation. It just pays bondholders for money we borrowed in the past. As that share grows, everything else gets squeezed. Either taxes have to rise to cover the gap, which reduces private sector resources and slows economic growth, or other spending has to fall, which means fewer services, less infrastructure, reduced benefits. Or, and this is what usually happens, the government just borrows more to cover the interest payments, which increases the debt, which increases future interest payments, which requires more borrowing, in a spiral that gets harder to escape the longer it continues. At some point, markets start to question whether this can continue indefinitely. They start to demand higher interest rates to compensate for the increased risk of lending to a heavily indebted borrower. Those higher interest rates make the debt burden even heavier, which makes the fiscal situation even worse, which causes markets to demand even higher rates. You can see how this becomes self-reinforcing. It's what economists call a debt trap, and once you're in it, getting out requires drastic measures, severe spending cuts, significant tax increases, or some combination of the two, implemented at exactly the time when the economy is already struggling under the weight of the debt. There's another possibility that's perhaps even more concerning, and that's the temptation to inflate away the debt. This is what Rome did when it debased its currency. This is what many governments have done throughout history when faced with unsustainable debt burdens. The logic is simple. If you owe money in your own currency, you can just print more of that currency to pay off the debt. The nominal amount you owe stays the same, but the real value of what you're paying back declines. If you owe $1 million and inflation doubles prices, you're effectively only paying back $500,000 in real terms. The debt hasn't been repaid so much as liquidated through currency debasement. The problem, of course, is that inflation is a deeply destructive force. It punishes savers and rewards debtors. It distorts price signals and makes planning difficult. It erodes trust in the currency and in the government that issues it. It falls most heavily on those least able to protect themselves, on retirees living on fixed incomes, on workers whose wages don't keep pace with prices, on the poor who lack the financial sophistication to hedge against currency risk. Inflation is, in essence, a hidden tax, one that doesn't require a vote in Congress but transfers wealth just as surely as any explicit levy. I don't think we're headed for hyperinflation of the kind that destroyed Weimar Germany or modern Zimbabwe. Our institutions are stronger, our economy more diverse, our currency more deeply embedded in the global system. But I do think we face the risk of persistent, elevated inflation that gradually erodes purchasing power, that makes life harder for ordinary people, that creates economic distortions and political tensions. And if that happens, it will be a direct consequence of our fiscal choices, of our unwillingness to live within our means, of our decision to borrow now and let future generations deal with the consequences. Let me share with you some principles that I've learned over a lifetime of watching markets and studying human behavior. Principles that apply whether you're managing a household budget or a national economy. The first is that you cannot escape arithmetic. You can use leverage, you can play with accounting, you can create complex financial instruments, but at the end of the day, if you spend more than you earn, you accumulate debt, and that debt must be serviced. There's no magic way around this. There's no financial innovation that repeals the laws of mathematics. Anyone who tells you otherwise is either ignorant or dishonest. The second principle is that compound interest is a force of nature. It works for you when you're a saver and against you when you're a borrower. The most successful investors I've known understood this intuitively. They let compounding work its magic over years and decades, reinvesting returns, allowing growth to build on growth, creating wealth through patience rather than cleverness. But compound interest is equally powerful in reverse. When you're borrowing, especially when you're borrowing to pay interest on previous borrowing, compounding becomes a weight that grows heavier with each passing year. You can't outrun it through growth alone. You have to address the underlying imbalance. The third principle is that incentives matter. People respond to the incentives they face. And if the incentives reward short-term thinking, if they punish discipline and reward profligacy, then you'll get more profligacy and less discipline. This is why fiscal rules, even imperfect ones, can be valuable. They create constraints that force trade-offs, that make the costs of spending visible, that reward stewardship over expedience. Without such constraints, the natural tendency of any political system is to promise more than it can deliver, to spend more than it takes in, to defer hard choices indefinitely. The fourth principle is that trust is precious and fragile. Financial systems, currencies, governments, all depend on trust. When people trust that a dollar will be worth a dollar tomorrow, they're willing to save and invest. When they trust that promises will be kept, they're willing to plan for the future. When they trust that rules will be followed and institutions will function, they're willing to participate in the system. But once trust is lost, it's extraordinarily hard to regain. And nothing erodes trust faster than fiscal irresponsibility, than the sense that those in charge don't understand or don't care about the consequences of their actions, than the realization that promises made won't be promises kept. The fifth principle is that margin of safety matters. This is something that Ben Graham, the father of value investing, taught Warren Buffett, and it served Buffett well throughout his career. The idea is simple. You want to buy assets with a significant gap between their price and their value, so that even if you're somewhat wrong in your analysis, even if things go worse than expected, you're still okay. This principle applies to public finances as well. You want to run deficits well below what you theoretically could, maintain debt levels well below what you technically could support, keep a buffer for unexpected events. Because unexpected events always happen. Recessions come. Wars break out. Pandemics arrive. If you're already operating at the limit of your capacity, if you have no margin of safety, then when those shocks hit, you have no room to respond. You're forced into desperate measures at exactly the wrong time. And the sixth principle, perhaps the most important, is that time is both your friend and your enemy. It's your friend when you start young, when you allow compound interest to work in your favor over decades, when you build slowly and sustainably. But it's your enemy when you delay necessary actions, when you let problems compound, when you wait for circumstances to improve rather than taking control of your situation. The earlier you address an imbalance, the easier the fix. The longer you wait, the more painful the eventual adjustment becomes. This is true for individuals drowning in credit card debt. It's true for companies with bloated cost structures. And it's true for nations carrying unsustainable fiscal burdens. So where does this leave us? What should we conclude from all this? I'll tell you what I think. I think we're at a crossroads, not in some immediate crisis sense, but in the sense that the decisions we make over the next several years will determine what kind of country we are in the decades to come. We can continue on our current path, borrowing trillions every year, watching our interest costs consume more and more of our budget, deferring hard choices, hoping that growth will solve our problems. That's the easy path. That's the comfortable path. That's the path that requires no sacrifice, no discipline, no political courage. And it's a path that leads, slowly but surely, to a future of diminished possibilities, eroded living standards, and generational resentment as younger Americans are forced to carry burdens they had no part in creating. Or we can choose a different path. We can decide to live within our means, to match our spending with our revenues, to prioritize what truly matters and let go of what doesn't. This path requires honesty about our situation, courage to make difficult choices, and a willingness to think beyond the next election cycle. It requires leaders who will tell uncomfortable truths and citizens who will accept necessary sacrifices. It requires a shift in our culture, from one that expects everything to one that makes trade-offs, from one that borrows from the future to one that invests in it. I'm not naive about how difficult this will be. I understand the political obstacles, the competing interests, the human reluctance to accept limits. I've watched enough budget fights and debt ceiling debates to know how hard it is to achieve consensus on fiscal issues. But I also know that arithmetic doesn't care about difficulty. The numbers are what they are, and they're moving in a direction that can't be sustained indefinitely. At some point, by choice or by force, we'll have to address this imbalance. And the sooner we do it, the less painful it will be. There's reason for hope, though. America has faced daunting challenges before and overcome them. We emerged from the Second World War with debt levels as high as they are today, and we grew our way out of it over the following decades through discipline, investment, and broad-based prosperity. We survived the stagflation of the 1970s by making hard choices about monetary policy. We've rebuilt industries, retrained workforces, and adapted to changing circumstances. We have enormous resources, human capital, innovative capacity, and institutional strength. What we need is the will to use those advantages wisely. I think about Warren Buffett's career and the lessons it offers. He built his fortune not through brilliance or exotic strategies, but through patience, discipline, and adherence to fundamental principles. He bought good businesses at reasonable prices and held them for decades. He avoided leverage and maintained large cash reserves. He said no far more often than he said yes. He never bet more than he could afford to lose. And over time, by letting compound interest work in his favor, by avoiding major mistakes, by staying rational when others panicked, he became one of the wealthiest people in history. But what strikes me most about Buffett is not his wealth but his consistency. The principles he followed in his 30s are the same principles he follows now. The discipline he maintained during boom times is the same discipline he maintained during busts. He understood that success in investing, as in life, comes not from being clever but from being sensible, not from taking big risks but from avoiding big mistakes. Nations need that same kind of thinking. They need to take the long view, to maintain discipline even when it's uncomfortable, to make choices based on arithmetic rather than wishful thinking. They need to understand that prosperity is not a given, that it must be earned and maintained, that it requires constant attention to fundamentals like productivity, investment, and fiscal balance. And they need to remember that every generation has a responsibility to the next, to leave behind a country that's stronger rather than weaker, more prosperous rather than less, more free rather than more constrained. I don't know exactly how this will play out. I can't predict when markets will demand higher rates, when inflation will accelerate, when political will might finally materialize for serious fiscal reform. What I can tell you is that the trajectory we're on is unsustainable, that the arithmetic doesn't work, that consequences will arrive whether we're ready for them or not. And I can tell you that the best time to address an unsustainable situation is always before it becomes a crisis. That prevention is easier than cure, that small adjustments made early spare you drastic measures required later. If I could leave you with one thought, it would be this: we still have time to choose. The situation is serious but not yet desperate. We have options, resources, and strengths that many countries lack. What we need is clarity about where we are, honesty about how we got here, and courage to do what's necessary to change course. We need to stop pretending that debt doesn't matter, that growth will solve everything, that we can keep deferring hard choices indefinitely. We need to have a serious conversation about what government should do, what we're willing to pay for it, and what promises we can actually keep. And we need to start thinking like stewards rather than consumers, like investors rather than gamblers, like adults responsible for the world we'll leave behind rather than children demanding immediate gratification. The math is patient. It will wait, but it doesn't forget, and it doesn't compromise. Every dollar of debt accumulated today is a claim on tomorrow's production. Every year of deficit spending is a year of compound interest working against us. Every delay in addressing the problem is a vote for making the eventual adjustment more severe. But here's what gives me hope. People are capable of remarkable things when they face reality clearly. Companies have restructured and thrived. Families have climbed out of debt and built wealth. Nations have reformed their finances and entered new eras of prosperity. It's possible. It's always possible. What it requires is honesty, discipline, and the willingness to make hard choices today for the sake of a better tomorrow. I've spent my life watching markets, studying history, and trying to understand how human beings make decisions about money, risk, and the future. And one truth I've learned stands above all others. Reality always wins. You can postpone it. You can deny it. You can paper over it with clever language and complex theories. But eventually, reality asserts itself. The laws of arithmetic don't change. The power of compound interest doesn't diminish. The consequences of living beyond your means don't disappear. They accumulate, compound, and eventually demand to be addressed. We're living in that accumulation phase right now, in the period where the bills are mounting but the crisis hasn't yet arrived, where warnings are still warnings rather than realities, where change is still possible through choice rather than forced by circumstance. That window won't stay open forever. At some point, we'll lose the luxury of choosing our path and will instead have to accept whatever path circumstances force upon us. But we're not there yet. We still have agency. We still have options. We still have time. What we need is the wisdom to use that time well, the courage to face hard truths, and the discipline to do what's necessary even when it's uncomfortable. Because the alternative, the path of continued denial and deferred responsibility, doesn't lead anywhere we want to go. It leads to a future diminished by the weight of past choices, constrained by obligations we never should have incurred, burdened by a debt that serves no one except those we borrowed from. We're better than that. America is better than that. We've overcome worse challenges with less resources. What we need now is the will to act, the clarity to see, and the courage to choose the hard right over the easy wrong. That's what stewardship demands. That's what the future deserves. And that's what I believe we're still capable of, if we choose to be.